Tired of scrimping every paycheck, cutting little luxuries, yet still watching your savings barely creep up year after year? You skip dinners yet delay small purchases, and faithfully deposit cash into your bank every month, convinced strict saving will set you up for a secure future. But when you check your balance, you spot a painful reality. $10,000 locked in a savings account, earning a measly 0.5% annual interest, netting you only $50 in an entire year. You scroll social media and hear everyone rave about stocks, index funds, and compound growth, leaving you confused and frustrated. You know saving is responsible, but deep down you suspect you're missing the whole wealth building formula. Millions get stuck in this exact loop. They master budgeting and saving, yet have zero clear roadmap to shift cash from stagnant savings into growing investments. Today, Bill will walk you through a complete, stress-free step-by-step system to convert your idle savings into long-term investment gains without endangering your daily financial safety. My name is Bill. If you hold idle cash in a savings account and feel lost about how to begin investing properly, hit subscribe and drop a like on this video for more straightforward personal finance guidance. At the end of this video, I will share 5 proven and practical methods to help you safely complete the full transition from pure saving to profitable investing. Let's open with a counterintuitive truth. Most finance influencers avoid sharing. Saving alone will almost never make you truly wealthy. Do not misunderstand. Consistent saving is vital, yet it is merely your financial starting line, not the finish line. Savings serve one single purpose: preserving the capital you earn. Investments serve a separate, far more powerful purpose: multiplying your capital over decades. These two functions cannot be swapped, and mixing them up keeps countless people stuck in slow financial growth. Let's break down the cold math to highlight this massive divide. Suppose you deposit $10,000 into a standard high street savings account with a 1% annual interest rate. After 12 months, your total balance hits $10,100, a tiny gain that barely offsets inflation. Compare this to long-term market investing. Historical data shows the S&P 500 delivers an average annual return of roughly 10% across multi-decade holding periods. The same $10,000 invested at a 10% annual rate becomes $11,000 after 1 year. The 1-year gap looks minor, but compound interest's exponential power transforms outcomes over time. After 20 years, your savings account holding $10,000 at 1%, interest will only grow to around $12,200. The identical starting sum invested in broad market assets averaging 10% yearly balloons to approximately $67,000. Same principle, two wildly different futures. The biggest financial separation in society does not exist between spendthrifts and savers. It exists between people who only save and people who save then invest. The barrier holding most people back is not complicated mathematics. It is raw human psychology. Savings feel predictable and secure. Investment markets feel volatile and risky. Your savings balance never has iterings randomly mid-week, while equities swing up and down daily. This emotional fear of temporary losses stops most people from ever allocating money to growth assets. You may think, Bill, I cannot risk losing the money I work hard to save. That worry is completely reasonable, which is why shifting money from saving to investing must unfold in gradual stages, not a single lump sum transfer. Below is the full 5 actionable framework to make this transition safely. Step E. Build a complete emergency cash buffer. Before investing any money, set aside liquid cash, covering 3 to 6 full months of all mandatory living costs. This fund lives exclusively in savings, untouched for market investments or speculative opportunities. It exists so live for unforeseen crises, sudden job loss, unexpected medical bills, expensive vehicle repairs. Most new investors are forced to sell their holdings at a loss because they lack emergency reserves and need quick cash. Amid market downturns, an emergency fund acts as a protective barrier between your investment portfolio and unpredictable life emergencies. Stepper. Create a strict mental separation between safety, capital and growth capital. Treat your finances as two separate buckets with distinct rules. Bucket 1 holds safety money, your emergency fund, never exposed to market swings. Bucket 2 holds growth money, funds you can afford to live untouched for 10+ years and tolerate temporary value drops in exchange for long-term appreciation. This simple mental partition drastically reduces the anxiety investors feel during market corrections. Step 3. Begin investing with tiny, regular contributions. A widespread beginner myth claims you need thousands of dollars to enter markets, but nearly all modern brokerage platforms accept initial deposits as low as $50 or $100. Your primary early goal is not chasing fast large profits. It is cementing the consistent investment habit. Long-term financial success relies far more on steady monthly contributions than perfectly timing market peaks and troughs. Step 4. Stick to simple, proven core investments first, avoiding overcomplicated high-risk strategies. New investors frequently jump straight into day trading, options contracts, or crypto speculation, chasing quick windfalls. Research consistently proves basic diversified assets outperform these complex, high-effort tactics over decades. Low-cost, broad market index funds stand out as the gold standard for everyday people. These funds track the entire stock market instead of gambling on individual winning stocks, granting instant diversification across hundreds of major corporations, layering off all portfolio risk while delivering reliable long-term growth. Legendary investor Warren Buffett has repeatedly advised ordinary investors to prioritize low-expense index funds for their core holdings. The most reliable wealth-building investment strategy is surprisingly unglamorous, consistent, recurring monthly investing. Let's examine a realistic example to demonstrate compound returns. If you invest $300 into market assets every month, with an average annual return of 8%, your total balance after 25 years will reach roughly $285,000. You personally contribute only $90,000 of that total. The remaining nearly $195,000 comes purely from compound investment gains, interest and dividend reinvestment. This is compound interest working relentlessly in your favor. Psychological discipline remains the make or break factor for all investors. When markets crash and media outlets publish panic-driven headlines, inexperienced people sell their positions out of fear. Steady discipline is the line dividing patient long-term investors from reckless short-term gamblers. A straightforward analogy clarifies the difference between saving and investing. Saving stores seeds sealed inside a jar. They stay intact, yet never multiply. Investing plants those seeds in soil. The process looks messy at first, and visible growth does not appear overnight. With consistent patience, those seeds multiply into a harvest vastly larger than your original handful. Many viewers will ask a critical question: what if you start investing and the entire market crashes? Market corrections and major crashes are normal, recurring events that have occurred dozens of times throughout stock market history. The hidden advantage for long-term investors during downturns is dollar-cost averaging. When share prices drop, your fixed monthly investment purchases far more units at discounted prices. Once markets rebound, those extra cheap shares generate amplified total returns. Veteran investors stay calm through volatility because they evaluate performance over decades, not single trading days or weekly swings. To recap the complete safe transition system: first, build a 3 to 6 month emergency cash fund. Second, split your money mentally into safety funds and long-term growth funds. Third, invest small fixed amounts each month to build sustainable habits. Fourth, prioritize simple diversified index funds with complex high-risk trading tactics. Fifth, maintain consistent discipline and grind compound interest decades to compound your wealth. The vital lesson every saver eventually learns is this: saving delivers financial stability, while investing delivers genuine financial freedom. The earlier you combine disciplined saving with steady longer-term investing, the stronger and more secure your future financial life becomes. If this step-by-step guide cleared up confusion around moving savings into investments, subscribe to the channel for more practical, personal finance advice. I want to hear from you in the comments. Are you still only saving cash without any investments? Or have you already begun allocating money to market assets? The moment you stop merely hoarding cash and start putting your money to work through investments is the exact moment your wealth begins growing on autopilot.